In today's class, I'm going to start going through the accounting cycle formally. And the first step in the accounting cycle is transaction analysis. So this is all new stuff today. I'm not reviewing anything from the past. I think it's time here to just dive right in and get started. So as I just mentioned, transaction analysis is the first step in the accounting cycle. And you can see here that your textbook authors have 7 steps in the accounting cycle. And we're at the very top at 12 o'clock on the clock, if you will, at analyzing transactions. And you can see that we're eventually going to move next into creating journal entries. And then on around the clock we go. But we're not going to get ahead of ourselves. We're going to take this one step at a time. And we're going to go through transaction analysis first. So again, we're eventually going to work through the complete cycle in the course, but not today. Today's just step 1. And we're going to spend at least a couple of days on step 1. So analyzing transactions, what does it mean and how do I do it? Well, in the normal course of business, many events will occur that must be entered into the accounting system. So let's be careful here, be precise. I didn't say every event that occurs must be entered into the accounting system, right? There are certain events that when they happen, they should not be entered into the accounting system. And as those come up throughout the course, I'll talk about those and why. But when you are just getting started, every event will need to be entered into the accounting system because that's what we want you to practice. I want you to practice figuring out how to put stuff in the accounting system. So I need to give you things that have to be entered into the accounting system in order for you to practice that. So we're just going to start out with everything will be entered into the accounting system, but in reality, that's not quite the case. So what are some examples of this idea of, business events? Right? Well, what do businesses do, right? They sell goods to customers or they provide services, right? So if Papa John sells pizza to a customer, well, that transaction needs to be entered into the accounting records because Papa John sold a pizza and that's how Papa John's earns revenue and makes profit. So that needs to be put in the accounting system. It could be services, right? If a doctor sees a patient for a checkup or a diagnosis, if the patient isn't feeling well and the doctor wants to see them and check them out, maybe run a couple of tests to try to diagnose what's going on with them. Well, that's how the doctor earns, his money is by seeing patients. And so that's a service provided. But it's still the same thing. It needs to be entered into the accounting records. Businesses have to pay their employees. And so when you pay your employees, that's going to need to be entered into the accounting records. Businesses will have to pay rent. If you have a store in a strip mall or in a mall somewhere and you're just renting the space, you'll have to pay rent every month. And if you've purchased a building and you borrowed the money, you're going to have to pay mortgage payment every month. Businesses also have to pay insurance. They have to pay utilities, just like we do, electric, gas, water, sewer, trash, and so on. So businesses have a lot of transactions that need to be entered into the accounting records. Now, before you can enter a transaction into the accounting system, you must know which accounts to use. You've seen financial statements. You've looked up companies' balance sheets and income statements, and you've become at least casually familiar with some of those accounts, like cash, or accounts receivable, or accounts payable, or notes payable, or common stock, or inventory, or sales, or service revenue, or cost of sales, or utilities expense, or advertising expense, or any other number of accounts. So when you think about how to put a transaction into the accounting system, the first thing you've got to decide is which accounts am I going to use? Which accounts should I use in order to enter this event into the accounting records accurately? Now, the first step, therefore, in transaction analysis is to determine which two accounts are being used. I emphasize two here. There needs to be two accounts. Two accounts. So don't read a question or an event and just write down one account. That's not going to get it done. There's got to be two accounts. Now notice my note here. Some transactions actually use more than two accounts. But for right now, in beginning accounting, we'll just start with two. We may see some events or some transactions later on in the class where we use more than two, and I'll stop and point that out. But for right now, let's just start with two. Now, notice my next note here. You never use only one account. So when you read a problem out of the textbook, you're analyzing a transaction, you cannot just list one account. That's incorrect. That'll be incorrect every time. This is because the accounting equation must balance. You've seen this before. We've worked with the accounting equation in a number of classes. This is also the balance sheet. If you only use one account, the accounting equation will not balance. So as an example, let's say you analyze an event, and after analyzing that event, you determine that because that event happened, you need to go into the accounting system and deposit $20 into the accounting system's cash account. So you're going to go into the cash account. You know it's an asset. You know the balances are on the debit side. You know money's going to come in on the debit side of that account. So you know you're going to deposit $20 into that account. You can see it in your mind's eye what's going to happen there in that T account. Now, when you look at that in terms of the accounting equation, it looks like this. You have cash going up by $20 on the asset side of the equation, but you don't have anything else. And mathematically, if you add $20 to the left side of this equation and you don't do anything else, you just stop right here, then this equation cannot balance. The addition of $20 into the cash account without doing something else will throw the accounting equation out of balance, and thus the left side will not equal the right side, and that's an error because the left side has to equal the right side, always and forever. So if I only use one account, whether it's cash or whether it's I only use a liability account or I only use an equity account, it's gonna throw the accounting equation out of balance. Whether you're adding or subtracting, it doesn't matter. It doesn't matter if it's just $1. It doesn't matter if it's just a penny. If you only use one account, it's gonna throw the equation out of balance. Therefore, in order to maintain balance, you must always have at least a second account. You must always have a second number to balance the equation. Now, how could I balance this equation? Well, if I add $20 to the left side of the equation, the first thing that pops into my head is that I should add $20 to the right side of the equation. And that would make it balance, right? But if I'm going to add $20 to the right side of the equation, I've got to have an account to put it in. I can't just put $20 over there. It's got to go somewhere. So I got to have a liability account or an equity account that I got to put that money in. And that will make the accounting equation balance. So this is why you must always have two accounts, at least two accounts. But for right now, you must always have two accounts when you do your transaction analysis. So for today, just try to identify which two accounts you would use. I don't want you to go into the accounting equation. I don't want you to try to make the accounting equation balance. I don't want you to think about whether you would be adding or subtracting money for that account, whether you'd be putting money into an account or taking money out of an account. I don't want you to think about any of that. I just want you to identify which two accounts you would use. You cannot say assets. Assets is not an account. It is a group of accounts. It is a type of account. You remember looking at the balance sheet. There are lots of accounts in the asset section of the balance sheet. Cash, accounts receivable, inventory, land, buildings, equipment, and so on. But you can't say assets. There is no account called assets. There are accounts that are assets, but there is no account called asset. So identify the specific accounts like cash or accounts payable or retained earnings. Identify the specific account you would use. So today, I'm going to work through part of exercise 2-31. It's on page 125. So if you want to go over to your textbook, it's right here. I'm going to be going back and forth, so if you just want to pull this up in a separate screen so you can look at it, that's fine. This is exercise 231. It's on page 125 of your textbook. So if you have your physical textbook, you can go get it. If you want to access the ebook instead, remember that I've put a folder in the left-hand menu of our course in Blackboard called Cengage. You can click on that folder, and then there's a link there that will bring you into the ebook link. So if you click on that link, it'll bring you into the Cengage Hub, which might be something that looks like this page. You have a menu up here at the top. Remember, over here on the right side, there is no link that says ebook, but the ebook is found in the study tools. And so you can come here into the study tools, and you can see they have different ebook links. I don't really know why. They're different versions of an ebook, so just find the one you like the best. I happen to like this one best, so this is the one I opened up. Okay? So exercise 231. Let's do letter A and see what I come up with. The following events occurred. Now, all of these events are going to go into the accounting system. We just need to figure out what accounts to use. In letter A, it says performed consulting services for a client in exchange for $2,900 cash. Here's how I do that. Performed consulting services. I'm going to back out of this. Performed consulting services. You can see it says it right here. Performed consulting services. You have a business that is providing consulting services for customers. If they're doing something for a customer, they're earning their money. So if Papa John sells pizzas, that's Papa John's earning money. If I own a landscaping business and I have a customer and I mow that customer's lawn, that's me earning money. Whenever the business is providing a service or selling a product to a customer, that's the business earning money. So here, performed consulting services means earning money. And earning money in accounting speak means revenue. So this account I'm going to call service revenue. Now you might call the account just revenue, that's fine. You probably wouldn't call it sales. Sales refers to delivering a product to the customer, not a service. So there's a distinction in accounting between selling products and providing services. So both of those could be called revenue generically, but sales revenue, or just sales for short, refers to selling a product, which this is not. This is performing consulting services. This is a service issue. So this is either service revenue or just revenue. Now it says over here, they perform consulting services for a client in exchange for cash. For cash. For cash means the cash account. So the two accounts for letter A, performed consulting services for a client in exchange for $2,900 cash, is service revenue and cash. Those are the two accounts. Let's go to letter B. Performed consulting services for a client on account, $1,650. So notice this question starts with the same phrasing, performing consulting services. That means in letter B, perform consulting services is exactly the same as it is in letter A, so it's going to have the exact same translation, if you will, into accounting. Perform consulting services means we're earning money, and if we're earning money, that's revenue, and that's service revenue, so it's the same. But notice the difference in letter B. Letter B doesn't say in exchange for cash. It says for a client on account, and that's different. So a big part of accounting is reading carefully and thinking about what you've read. A lot of people, think about accounting as kind of a math class with lots of numbers, and there are lots of numbers in accounting. But accounting, as much as it is about math, it's every bit as much about reading. So read carefully. Now, on account. What does on account mean? On account, my second bullet point here in the middle, on account means the customer has not paid yet. How do I know the customer has not paid? Because it doesn't say perform consulting services for a client in exchange for cash. It doesn't say that. If the client had given me cash, it would say in exchange for cash, just like it did in letter A. Or it would say the client paid me. That's how I know I got cash, when I got paid. But this doesn't say anything about in exchange for cash, and it doesn't say anything about getting paid. It says on account. So on account means the customer has not paid yet. If the customer is not paid yet, that means the customer owes me the money. The customer owes the business the money because the business has done their part. Basically, the business entered into an agreement with the customer. The business agreed to provide consulting services for the customer. The customer agreed to pay. The business has done their part. They have performed the consulting services. The client or the customer has not paid yet. So that means the customer owes money to the business. And from the business's perspective, that situation is going into the accounts receivable account. This is an asset to the business. Accounts receivable represents monies owed to the business by customers. The customers owe the money because the business has already provided the service or product to the customer, and the customer is not paid yet. So that represents, from the business perspective, an asset because that's money that's owed to the business by customers. So the two accounts for letter B are service revenue and accounts receivable. Now, I'm going to put an assignment up on Blackboard, and that assignment is going to be for you to go through the rest of that problem, the problem I just showed you out of the textbook. Go through the rest of that problem, and for each item, list the two accounts that you think are being used. I don't expect you to be perfect. This is your first attempt at transaction analysis. So all I'm looking for here is a solid effort. I'm not looking for perfection. So I don't want you to stress or, get all bent out of shape about, I don't know what I'm doing or I'm confused. Yes, you may not be on sure footing here, right? You may not be very confident. But I also don't want you to slack, right? There are some PowerPoint slides that I've put on Blackboard from the textbook authors. You could open those slides up and look at some examples in there. If you get stuck, maybe that could give you a hint or a feel for maybe how to do that. You can go in the textbook and read in this section. It's chapter 2. You can find the section where it's talking about transaction analysis. It should be pretty close to the beginning of the chapter. It's not right at the beginning, but it should be pretty close to the beginning of the chapter. So use some resources. Give it a solid effort. Don't turn in blanks. Blanks can't possibly be right. And don't ditch the assignment because it's too hard and I can't do it, so I'm not going to turn it in. because it's not going to get any better. Right? So give a good, solid effort. And as usual, let me know if you have questions.